In today's video, I want to talk about the line that's being drawn in the sand between traditional investments and alternative investments. Now, just recently, one of the largest, most powerful banking and wealth management institutions, one of their representatives made a public statement just recently. This is post 2024 election. And this rep was basically making a statement about what their investors, which make up millions and millions of investors with this particular institution, their investors should expect no more than maybe a 3 to 5% yield on their investments. Now, of course, these are investments that fall under the category of traditional investments: stocks, bonds, money markets, CDs, savings, 401ks. I should have even put pensions, because all of these traditional banking and wealth management institutions primarily get their money from individuals who deploy their money in pensions, 401ks, CDs, savings, money market accounts, or stocks and bonds. So, for example, if you work on a job and you contribute certain money to your retirement, whatever type of retirement it is, and your employer contributes or matches you, well, that money is going somewhere, because how are you going to actually have money 30, 40 years from now or 20 years from now when you retire? Or if you give it to a bank, that money has got to go somewhere. Well, a lot of times that money is going to go to the traditional investments or to the big institutions who are lending that money out on massive levels, or they're putting that money in certain vehicles that they know will yield them a return, and it will yield those who are at the point of retirement or who are cashing out a return. But for the most part, they're not looking at the return, meaning that the people who run these institutions, their return is really coming from the fees that they're getting paid. Because we're talking about, like, this particular institution that I'm referring to, they have over $3 trillion of assets under management. So just think, if they're only getting a 0.1% of management fees, we're talking about $3 trillion, billions and billions of dollars a year that they're going to net just from management fees. Now, why is this important? Well, there's a long line being drawn in the sand, because the money that's being deployed by big institutions through to these traditional investments, where's this money coming from? This money is coming from the everyday people like you and I, or at least the everyday people who are working W-2 jobs, the 1099 contractors, the preachers, the small business owners. We're putting our money in money market accounts, CDs, savings accounts, 401ks, pensions. We're waiting for that money to come back, stocks and bonds. So all of our money is being used at scale on a massive level. The line that's being drawn in the sand is really an information line, but also an action line, meaning that what you're hearing me talk about now, a lot of my peers, those who are on the front line of entrepreneurship, small business ownership, those of us who have merged into at least a small level of real estate investments and asset management, we are informing our peers and our mentees and students and colleagues and those that we come into contact with in our community that you need to start looking at alternative ways to invest, so that A, you can control the narrative of your own money, but B, not just control the narrative of your own money, but accelerate whatever it is that you are anticipating to do with your money. So whether you're anticipating to use this money for retirement, to have some level of financial freedom within the next few years, to buy a house, to take care of your children, to fund college, whatever it is, if you want to accelerate that, well, they're already saying, the writing is on the wall, that you should not only expect 3 to 5% yields. That's what one spokesperson or representative said. But what they're saying in code is, y'all should be expecting losses. I mean, I've talked to a good handful or two of people just within the last 6 months or so, and a lot of them that I've talked to have told me, when they just look at their dashboards of their retirement accounts or whatever it is that they have money sitting in for the last 4.5 years, it's been so volatile. There are some people I've talked to who have lost money. And so you at least have to consider. Now, does that mean you should take all of your money out of banks, all of your money out of your 401ks and your pensions and your CDs? No, I'm not saying that. You speak to your financial advisor, your CPA. You speak to whoever it is that you trust. I'm just an entrepreneur that's helping investors that I work with make double digits on their money. I'm an entrepreneur that's looking to solidify my legacy. I'm just an entrepreneur trying to make sure that my staff and my community and the people that I come into contact with understand that there's an alternative way to make money that doesn't box you into the traditional way we've made money, which doesn't work for a lot of people, at least in the long term. So if you look at the traditional investments, stocks, bonds, money markets, CDs, savings, 401ks, pensions, and the like, put it against real estate, like fix and flips, buy and holds, whether it's residential or commercial. Put it against private lending. Put it against syndication. These are alternative investments that typically yield a minimum, at least for the people that I've worked with, of a 10% return. Like, for example, when someone operates as a private money lender on a real estate deal that I do, which is primarily going to be a fix and flip or a buy and hold, it's residential, well, they're automatically going to get a 10% return on their money, where that same money that they are using as private money lenders, it will be sitting in a CD, a savings, a money market, maybe yielding them 4 to 5% annually, where it's automatically 10 over here. I know a lot of people who have 401ks, a few $100,000 sitting in retirement accounts, where they are learning that they can self-direct their IRA, meaning that they can take whatever retirement money they have, create a self-directed account in which we have custodians that we work with who facilitate all that, and it's all legal and legit. And they can take that same money that's just sitting dormant and not really getting that big of a yield, put it in vehicles like real estate, lending, syndications, and massively accelerate their retirement. These are the alternative investments that everyday people will have to start considering if you don't want to allow yourself to get to a point in the future where you realize, wow, I shoulda, woulda, coulda, but I didn't. So the big institutions are already drawing a line in the sand, and they're speaking to some extent in code. But for those of us who are informed and who are willing and ready to take action, we're learning how to take resources and capital and things that we have sitting in traditional investment vehicles and redeploy them in alternative investment vehicles to not only solidify our own destinies and legacies, control the narrative of our own lives, but accelerate the process of whatever it is we want to do for ourselves, for our families, for our churches, for our communities, and for our future. If you want more information on how you can deploy capital into certain alternative investments, don't hesitate to reach out to me and my team. We have custodians who work with individuals who like to self-direct their IRAs. We have investment deals that we regularly do. We have a group of private money lenders that we currently work with. And guess what? We have a community of students and mentees who are learning all the ins and outs of this, so that not only they can do it for themselves, but that they can share it with their family members, friends, and communities, so that we can solidify our lives and get us and our families to the next level. I'll see you in the next video.